So in terms of policy management, there's, I didn't realize the four things, but it kind of works perfectly. So you've got the policy management piece. I would also imagine that the things you learn on the policy management side also sort of inform you on how you do due diligence on products today. So what is your, the 10X piece for policy management, pretty clear on that. How does it work for product selection? What's kind of the 10X overlay for you guys on product selection? How do you pick product? How do you screen product? What does that look like?
Well, the other four things, or the other three things, go back to product selection. So we are learning from policy management and can score by product, by company, what percentage are on track, levels of satisfaction. So what we are learning from in-force business is instructive to product selection. But it's also company. You think about, we sold some business with Lincoln Benefit Life, and no one is thrilled that they got that last round of really low pricing before it got dumped off to private equity.
Yep.
There is no good product without good companies. And again, I kind of reinforces my thought on variable. The poor Voya policyholders are going to now be in for the same treatment as the Lincoln Benefit policyholders. And I can tell you one thing for sure: the separate account policyholders are in way, way better shape with whatever happens, whether they're with New England, whether they're with Voya, whether they're with Met, whether they're with Lincoln Benefit. So that, again, my experience shows that variable gives us a lot more choices, true upside and protection and downside. I think another key thing that we look at, maybe it comes from being a lawyer, is we look at illustrations, but we buy a contract. And our senior analyst, Tom Love, just does this incredible work, kind of like a Cliff Notes version of your work for each product we sell. So we'll go through and say, okay, here's how the no lapse provision works on this product, and if you miss it, it's going to cost you 5 times as much. Or on an IUL, the key contract provision is this cap can be reduced to 3%. And the insurance company doesn't have to do anything other than decide to do that. Or on some products, we're going to move you out of this index and we can substitute you into anything else we decide. So understanding what the contract says is very key. I think when it comes to looking at products, our business model is different. Distinctly different in some ways. Most producer groups have this aggregation model where all the wholesalers call on each office, and it's up to each office to try to figure out what's going on. We've built out this staff of analysts that do that work for our firms, and they break the products, they push the products, and one of the things we're really looking at is, if this doesn't work, what's the downside? What is your cost to correct this if it jumps the tracks? And I think that really informs the work we do.
You're right. All four really do feed into that product selection piece. Let's talk a little bit about companies. You've mentioned some historical failures, Confed, Executive Life. Maybe that was part of what spurred you guys to do what I think is the gold standard in some ways in terms of insurance distributors trying to get a feel for the companies they work with, which is your star ratings. So talk a little bit about that and kind of how you guys try to look at company strength through your own lens. You don't just take Comdex, you don't just take Alert. You guys have actually put your own kind of view on this.
Well, part of the reason I think ratings don't work is we just mentioned Confed, which was AAA 18 months before it went into receivership.
Wow.
Or you think about the MetLife policyholders who are now shoehorned over at Bright House. So you could take the biggest insurance company in America, take out all the stuff they don't want, push it into a new box, call it Voya, call it Bright House, and you got completely different ratings. So ratings are no indicator of the financial strength of the policy you'll own when you need it. And they're group ratings. They're based on the Met Investors Life always being under the big med umbrella, and that in my experience doesn't happen. So this is going to change. So one thing I look at is with the stock companies, I look at what are investors saying about these companies, what's happening, what are they telling the SEC in forms where they have to tell the truth about. Another thing that we look at, we've got this committee that meets quarterly, is debt instruments, including for mutual funds or mutual companies. So the life insurance industry in the first half of 2020 floated more debt than they did all of last year.
Wow.
And the strong companies could float debt. So you look at New York Life and Guardian and Mass Mutual, all floated significant surplus notes where investors were willing to lend them money for 30 years at below 4%. That's certainly a sign of strength for those companies. But you have other companies that can't get debt financing at all. And or if, let's say, that the debt's issued at 400 basis points more, that's a risk premium. Investors are saying, if I'm going to give you money for 10 years instead of 30 years, I want 400 basis points more. And they are really looking at these companies with, I think, a much more objective view of what is the risk that's going on. So we look at debt issues. I do like the alert ratings because they look at the underlying issuing entity rather than the group. We look at things like a price to book ratio. Even the best life insurance companies, the most well-capitalized ones, are selling at 40 to 50 cents of their book value. And if you look at the S&P 500 and the 10 stocks in the S&P 500 with the lowest PE ratio, 3 of the 10 and the lowest are Prudential, Lincoln, and Met.
Wow.
It's just because it's a tough business. It is a really tough business. And those, what I say, I would look at those as 3 of the stronger companies in terms of capitalization, ability to raise money, well-run businesses. But it's just tough for the U.S. life insurance industry.
Do you feel like, on the whole, after doing all that analysis, you actually are more confident about your ability to predict financial strength in insurance companies?
Yes, I do. I think Andrew Carnegie said, the older I get, the more attention I pay to what people do instead of what they say. So every single company says, we're rock solid. We're just, we're buying all these great investments. We're not worried about bond yields. We don't have any commercial mortgages that are in trouble. I mean, that's what they tell. And Confed was saying, oh, don't worry about this. Just a temporary blip,
Right.
And I'm sure your dad with General America, oh, no, it's no problem. I've never heard anybody say, oh, man, it's bad.
I'm worried, I'm worried more these days about, it's not even so much a solvency thing. It's a MetLife Bright House situation.
Yes.
And, obviously nothing has happened that's negative for Bright House policyholders. They've taken a hit in ratings and they're not as well capitalized as Met. I think that's sort of not debatable, but I was in the middle of that, in the guts of that, and I can tell you Bright House fought to be better capitalized, and they were better capitalized by the time it was all said and done. And I think that it is definitely a downgrade for policyholders, but it doesn't mean that it's fatal for policyholders by any means, right? They're still a healthy, strong, going forward company. So the issue I see more in the marketplace is, and I'm going to use Pru as an example. Pru, the entirety of their life and annuity business is written at Pruco, which is a sub of Pru, and then it's entirely reinsured, an Arizona sub of Pru, and then it's 90% reinsured to, on the life side, 90% reinsured to captive insurance companies down in Arizona as well. And so I look at that and I go, well, you can do all the analysis you want on Pru, But at the end of the day, whenever Prue feels like pushing the jettison button, they can easily jettison the entirety of their life and annuity operation with basically the click of a button. I would argue easier than MetLife could, because MetLife had some entanglements. Peru doesn't. They isolate the whole thing down at the Arizona entity, and they can just click the button and push. So how do you handle uncertainty like that? How do you think about that? And you guys write a lot of Peru, and a lot of people write a lot of Peru. So how do you guys think about issues like that?
Well, two things is one, recognizing that and being truthful about it and say you're not buying from Met, you're buying from Met Investors Life, you're buying from Pruco. If it's AXA, you're not buying from AXA, you're actually buying from a Moni sub, so it's saying this is what it is. But I think the biggest thing, again, goes back to separate accounts.
Yep.
If we have two products, one that allows the insurance company to change 90% of the deal, like IUL, and the other, if it's well-funded variable, and you say, hey, if they turn every lever against you, it's going to impact 15% of the value. So I call it the SEC tamper-proof packaging, of a prospectus. So even in the worst of circumstances, this is a separate account. But in my experience, if we have a receivership or a problem, somebody else will pick up those blocks because they're profitable. Nobody wants the underpriced GUL or the long-term care or the stuff that is under reserved. So I think again goes to why the case for variable in good times and in worst of times.